This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasuries receive a jolt after soft US jobs data supports the case for a super-sized rate cut by the Fed. Stocks, though, tread water ahead of tomorrow's key reading on non-farm payrolls. Kamala Harris breaks with Joe Biden on tax rates. The US Democratic nominee says those earning $1 million or more should pay 28% on capital gains. And Bloomberg understands that OPEC Plus is close to agreeing a delay to a planned hike in output. That's as Brent crude trades near a 14-month low. Happy Thursday. So the action yesterday across asset classes was more pronounced in the Treasury markets than it was in equities. A big move once again across the curve, with the moves really being felt at the front end and around 8 basis point yield move lower in terms of the 10-year. The setup for the equity markets today then treading water could be the way to characterize it, leading up, as we've said, to that non-farm payroll sprint, the jobs sprint out of the US on Friday to get further clarity. But the jobs data in terms of the openings, the jolts again, that number, the number of vacancies dropping to the lowest level since around 2021, leading to that move and expectations that the Fed will have to be more aggressive in its cutting cycle. European futures pointing to losses of 0.2% after the downside of yesterday. FTSE 100 looking to losses around 17 points as things stand. S&P futures also down by 0.1%. Nasdaq futures looking at losses of 54 points. Worth noting that Nvidia saw its biggest two-day loss since around October of 2022. Let's flip the board and look cross-asset. We talked about the moves into US Treasuries. That was marked, as I mentioned, and the 2s, 10s curve briefly disinverting. We continue to watch that. Currently, that's flat, essentially, between the 2s and the 10s right now. 376. Not a lot of movement so far in the session. Euro dollar 110. Brent $72 a barrel. We'll unpack the story around oil for you. Currently up 0.3%, but of course losses earlier in the week of around 8%. Iron ore at $90 per tonne, currently down 2%. Further pressure coming through for iron ore on that continued question mark around the demand out of China. Let's cross over right now to Singapore. Avril Hong standing by for us for a check on the Asian markets. Avril.
Yeah, Tom, we initially in the session saw a recovery in Asia's stock gauge, 1+% climb, but that seems to have disappeared and the rebound is pretty unconvincing. If you take a look at what we're seeing among the chip names, for example, we are seeing a mixed bag. The ones that decline the most, like TSMC, climbing about 2% today, but elsewhere, a lot of them have flipped into negative territory. I think our traders are coming to this realization that this AI narrative about how difficult it's been to justify the rally, that has been very difficult to shake off. The other thing to consider is also as we keep an eye out for jobs numbers later in the week, especially after what we got from the US job openings, there's that added layer of uncertainty there. Amid all this, we are seeing the stocks on the mainland holding out pretty flat. We did get the likes of JP Morgan scrapping their bullish case for Chinese equities, and this is as it's citing some of these risks surrounding a potential trade war ahead of the US elections. But on the flip side, you had this Bloomberg story, right, about how China is considering a 2-step mortgage rate cut, and this essentially would be a form of wealth transfer to households, maybe lift the consumption picture a bit. But again, as we've been harping on repeatedly, this is a market that has lost animal spirits. So really, really difficult to reinvigorate that. Let's flip the board. As we see that mixed picture on some of these chip names, it is actually the Japanese ones that are extending those declines today. And this is perhaps no thanks to what we're seeing on the Japanese currency. We did see it rallying yesterday after what we got from the US job openings numbers, and indeed today after data in Japan which showed labor cash earnings climbing more than expected. That kind of backs the case for another BOJ rate hike, but it has pared those gains because perhaps markets are kind of passing mixed signals from a BOJ board member, Takata, coming in today saying that, yes, they could hike again if the data justifies a case for it, but also saying that they are watching markets with a high sense of urgency. So on dollar yen, you see it's not really giving us that clear of a direction, hovering around the 143 level. If you flip the board, as you see these Japanese equities lagging with the concerns around the Japanese yen, flip the board, take a closer look at this chart, which will also show you that in terms of dollar yen and how the risk reversals are pricing things, it's actually been lagging what we're seeing on the pair. And this gives us a sense that perhaps traders are bracing for this sudden jump in the US dollar. And that also could point to potentially dollar yen moves being accelerated lower if options pricing actually catches up eventually. Tom.
Okay, of course, the dollar yen and its future very much dependent as well on what happens with the Fed, as you suggest, and we'll get more details in terms of the thinking around the Fed right now. Avril Hong, thank you very much indeed, out of Singapore with a check on the Asian markets. So on that point, Treasury yields then climbing after that soft US jobs data. Bolstered bets then on steep rate cuts by the Fed starting this month. The co-founder of Oaktree Capital, Howard Marks, says he doesn't expect rates, though, to go below 3% ultimately. Bloomberg M Live strategist Mark Cranfield joins me now. So, Mark, we saw the job openings down, we saw layoffs up, we saw the Fed beige book suggesting that there is a stagnant US economy, at least on some measures. Traders then getting excited again about a jumbo rate cut, and you were one of the first people to put this on the table as a potential option for the Fed. Are they overdoing it now, pricing in around 34 basis points for that September 18th decision?
I think what traders can see is that it has to be discussed at the next FOMC meeting. Whether or not the Federal Reserve actually go ahead with 50 basis points or 25, traders can smell that they can't avoid this. It has to be on the table for discussion. It's a bit like the recent New Zealand central bank meeting. They went ahead with a 25 basis points reduction, but they acknowledged in the minutes afterwards that they had talked about lowering by even more. And I think that's where traders are now. They can see the Fed has no choice. There's a sufficient stream of data which is subpar, as you're talking about the jolts numbers there. The beige book was also a bit bland as well. People can see that it's moving in a direction where the Fed may have made a mistake by not lowering rates in July, and they may now need to rush to do even more. So they're almost certainly going to have to talk about cutting by a jumbo amount, even if they finally don't go ahead. Now, what's very interesting about the jobs report tomorrow is that after the data comes out, we have two Fed speakers coming up who may shed light on how they view those numbers and may encourage traders even more if the fallout from that is that the numbers were particularly weak and it could lead to a larger cut. So it's going to be a very interesting day tomorrow, not just how the numbers themselves come out, but how the Fed speakers respond to those numbers as well in view of the upcoming meeting.
OK, really interesting. The combination then of the data and the response then from a couple of FOMC members. Talking about how to interpret the Fed's next steps, we've been hearing from Howard Marks, speaking in Melbourne, Australia, of course, of Oaktree Capital, someone with deep experience that the markets often listen to, saying that, yes, we will get cuts from this Fed, but you're not going to get sub 3%. What do you make of that? What are traders making of that interpretation, that assessment?
This is all about the conversation around where is the neutral rate going to be in the US terms. So we've heard various people talking about it, and it's a conversation that will pick up a lot more once the Federal Reserve has started to lower interest rates, because then people will need to know where are the parameters for this, where are we going? And something like 3% looks like a reason. If you look at the historical background to where Fed rates have been, 3 is certainly a number where they have stopped before. And if you look at the derivatives, the very long-term derivatives curve, it's about where people are pricing for. Now, of course, this is not perfect science. This could well change if the inflation numbers become even softer, if the jobs market deteriorates more quickly. But this is where we're going to get the big swings in the yield curve. This is why the inversion in the curve has pretty much gone now. We're more or less flat, but we're likely to chop around for a while as the data comes through. And it could well be that as people start to crystallize around what is the correct neutral number, that can help to boost the steepening of the curve, providing that the Fed does indicate that they're going to more or less match the path that is priced in by traders. If they don't, if they push back against it, you'll see the curve go inverted again, most likely, and people will have to reassess. But this whole conversation about neutral rates that Mr. Marks has kicked off here, that is the big one once the Fed actually starts lowering rates.
OK, we get the cuts and then we get the conversation and more clarity, arguably, potentially, on the neutral rate. Bloomberg M Live strategist Mark Cranfield with a great setup once again for us as we lead up to non-farm payrolls print, of course, on Friday. Mark, thank you. Let's get to the commodities space then. What a week it's been for oil. OPEC Plus delegates now telling Bloomberg that they are close to an agreement on delaying a planned increase in oil production. That's after Brent crude slumped this week to its lowest since last year, following downbeat economic data from both China and the US. Let's get more on this story with Bloomberg Horizons anchor Jemana Pasechi, who's been following it all for us throughout the week, joining us from Dubai. Jemana, what has Bloomberg then learned from OPEC delegates around their thinking?
Yeah, well, after the slump in oil prices of about 9% during the course of this week, there were lots of questions as to how OPEC Plus were going to take on this data and whether it would actually change their plans. So let me just rewind a little bit back to what we got out of that June meeting earlier this year, because the highlight of that meeting was that OPEC Plus, the whole group, had actually agreed to extend the majority of their output cuts into 2025. But a small group, 8 members of OPEC Plus, agreed to start tapering their voluntary reductions of 2.2 million barrels per day from the fourth quarter of this year all the way out to the fourth quarter of 2025. So that was the plan, but of course subject to market conditions, which in theory would mean as of October this year, another 180,000 barrels per day of oil would start coming back to the market. Now remember, back when they took that decision in June, Brent was averaging around $82. Look at where we are right now, $72. So no wonder they are allegedly rethinking their plans to bring those extra barrels back to the market. According to our own reporting, delegates from OPEC have told us that they are reevaluating their position, at least for October, and then we'll see later on in the year, again, what the oil complex looks like. But for now, it does appear to be the case, Tom, that OPEC Plus delegates are considering pausing the tapering that would have taken place as of the fourth quarter of this year.
OK, that reported re-evaluation then by OPEC Plus members. Currently Brent at 72.96, up 0.4% so far in the session. Jemana, what are the other drivers to watch out for then in terms of how we think about the future steps, the next moves for oil?
Well, I'm going to give you a central banker answer, and that's data. Just watch out for the data. The data that came out this week, China data showing weakness of demand there, was one of the catalysts for the bearish move lower. Tomorrow, of course, the labor market data in the U.S. is going to be a big signal as well. It's a big difference for the commodities markets, whether the U.S. is in a soft landing or in a hard landing. So that's a major driver on the demand side. On the supply side, we keep talking about it. It's not just about the potential barrels that OPEC Plus are going to bring back to the market, but also the sheer volume of non-OPEC supply that is expected to hit as well. You think of the likes of U.S., Brazil, Guyana, one of the strongest growth markets in oil space over the last year or so. IEA are estimating that an extra 1.4 million barrels per day will come onto the market just from new supplies in 2025. And so all of this has led some think tanks out there to say that the market is going to be in a surplus situation. And if you have that, it will be very difficult to see further upside for oil from here. But on the flip side, the short-term data, we look at some of the U.S. stockpile data that came through yesterday, has shown a decline, another big drop versus where we were back in June, which tells you perhaps seasonality may be at play here. And short term, given the news from OPEC, given the U.S. stockpile situation, we may start to see some support, which has come through in the last 24 hours.
OK, Jemana Pasechi with a reminder there that Jemana would be an excellent central banker as well as anchor of the Horizons show, of course. With the update on the oil markets, Jemana, thank you very much indeed. Here's what else to be thinking about today then. 1:15 p.m. we get a little bit more clarity on the jobs picture in the US after, of course, The jobs opening data really moved those Treasury markets yesterday in terms of the shrink and the decrease in the vacancies and the increase in layoffs. So we get ADP, the private payroll print that comes through 1:15 p.m. August for the month of August, expected actually to move up from the previous month. 3 p.m. UK time, meanwhile, we're going to get the services PMI data after that contraction for the fifth straight month in terms of manufacturing. There has been a divergence between manufacturing and services. That crosses at 3 p.m. UK time. It is the US ISM services PMI. And after market, we're going to get a touch again on the AI space with Broadcom earnings. That will give us an interesting picture in terms of demand for their semiconductors. You can get a roundup of the stories you need to know, of course, to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the top stories this morning. The tax plans coming through from Kamala Harris, a bit of divergence from President Joe Biden. That is interesting. Other lines coming through as well. Howard Marks and his view that even if you get cuts, there is an expectation that Howard Marks from Oak Tree Capital that you will get those cuts from the Fed, but even if you do, you're going to get back below 3%. It'll still be above 3% in terms of the neutral rate for the Federal Reserve. So check in on Daybreak for some details on those top stories. Coming up, Kamala Harris says she will raise those capital gains taxes then if she wins the race for the White House to ensure America's big earners pay their fair share. The number she's landed on is 28%, the latest on the US election and her economic plans next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Now, US presidential nominee Kamala Harris wants to raise capital gains tax on people earning $1 million or more, $1 million or more. Speaking at a campaign event in New Hampshire, the Democratic candidate said America's wealthiest should pay their fair share.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
OK, for the details now, joined by Kriti Gupta, of course, anchor of The Opening Trade, who follows all the twists and turns of this US election for us. Kriti, what do you make of these plans, these proposals coming through from Kamala Harris and what it tells us about her economic priorities?
Yeah, well, this is a stark difference from her predecessor, Joe Biden. And, of course, she's been vice president to Joe Biden. So you would think that they would have a lot of the same policy implications. But what she's coming under right now politically, and before I get into kind of her predecessor, is a criticism that she doesn't understand economics. And remember, she's already expanded on Joe Biden's thoughts around price gouging, around Medicare, et cetera, where there is a concern that if you start to include price caps and make things more affordable, as she says, on things like groceries, on things like healthcare, et cetera, you basically create a stagnation in the economy. So this kind of feels like a response to that when she talks about this capital gains tax, which, by the way, has also been very heavily critiqued by Joe Biden, who was looking to increase it to as high as 40% if he had gotten a second term, really, again, making the same argument that the wealthy should pay their fair share. She's actually saying, no, maybe it should only be 28%. That's the number that she's providing, which is still significantly higher than what it is at the moment. The current is about just shy of 21%. So that's what you want to keep your eye on. But it is still a marked difference and substantially lower than her predecessor. The piece that you need to keep in mind is that Donald Trump has also looked at this capital gains tax and is also saying, look, this needs to be brought down even lower. He's talking about a cut towards it. So this is, again, something that's going to show up in corporations and high net worth individuals and also affect how people who are invested in the stock market are able to reap those gains.
How seriously should investors take this? Because it's one thing, of course, making it as a proposal and another thing actually getting it through Congress. And, of course, that comes down to how and to what extent there's a split coming through after November. So how seriously should they take it? And to what extent could this prove damaging in terms of Kamala Harris's relationships with corporations? Or is it the fact that she's coming lower than Biden actually seen as a positive by the business community?
Well, this is seen as a positive by the business community. And I'll start with your latter and then head to the former. It's a positive simply because Democrats aren't seen as market-friendly participants traditionally. enter Goldman Sachs. And I think this is a really interesting call coming out of Goldman Sachs, because one of the concerns here around, again, Kamala Harris is that you're coming into a little bit of a late cycle U.S. economy. There's a consensus here that we are towards the end of it and therefore slowing down, and that recessionary call is getting louder. The timing of that, of course, is unclear. But if you look at what Goldman Sachs is actually saying around the GDP itself, they're actually talking about a very slight boost to GDP growth under not only a Kamala Harris presidency, but a Democratic sweep of the House in 2025 or 2026, compared to what that might look like under President Trump in the next 12 months, were he to be elected to office, really citing a hit to GDP there, saying a peak of about 0.5% in the back half of the year. This is a big deal because they're basically highlighting concerns around immigration, curbing immigration. Remember, a lot of the immigration growth has really spurred the labor economy in the United States, feeding that consumer resilience that we're continuing to talk about. They're also assuming a 20 percentage point import tariff from China as well, not to mention auto imports in Mexico and the European Union. They're saying none of that is likely to happen under Kamala Harris. So that is the marked difference, and that's also why market participants are starting to say, okay, well, maybe your international and domestic policies could be more market-friendly.
OK, Kriti Gupta, thank you very much indeed. As Kamala Harris fleshes out those economic plans and the divergence now, it's emerging, at least on some of these policies, between, of course, Trump and Kamala Harris. Coming up, military cooperation and $50 billion in financial support. China going all in on strengthening ties with Africa. More details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, China's President Xi Jinping has vowed to provide Africa with $50 billion in financial support over the next 3 years and strengthen military cooperation in a sweeping effort to deepen China's relations with the continent.
After hard work in the 1970s, China-Africa relations are now at their best period in history. I propose to elevate the bilateral relations between China and all African countries that have diplomatic relations with China to the level of strategic relations.
OK, let's go to Bloomberg's Ondiro Gunga, who is in Kigali for us. Ondiro, then, from the lens, at least from the continent in which you sit, what were the highlights from President Xi Jinping's speech? This is a major event in Beijing, bringing together, 40, 50 leaders from across the continent. His message, how well received will it be, do you think?
Mm-hmm. Well, Tom, this is a speech that failed to live up to expectations. It was highly anticipated and also highly looked forward to, because judging from the number of African dignitaries that made their way to China, they were expecting that things will be the way they have been in the last couple of years, but it is not. President Xi Jinping's checkbook is a little tight at this time around, only putting out $50 billion over the next 3 years, $30 billion in credit line, $10 billion vaguely worded as various assistance, and another $10 billion from Chinese companies investing on the African continent. And this just signals that the old era is gone, the era of mega infrastructural projects and massive funding into the continent. That chapter is closed. President Xi Jinping terms this new chapter as a chapter of small and beautiful projects. So every single cent that will flow into the continent will be well thought through, well budgeted for. And we're also seeing China gearing away from the traditional projects that they've been doing and going towards renewable energy. And everything that they do, any good deed that they do on the continent, will have greater benefit in China.
OK, Bloomberg's Ondiro Gunga in Kigali. Thank you very much indeed with the assessment of that speech from President Xi Jinping to African leaders. We're going to have more in terms of China's relationship with Africa in this month's edition of Africa Amplified. That's tomorrow, 5:30 a.m. London time. Coming up, though, Ukraine's president makes his biggest cabinet reshuffle since Russia's invasion. We bring you the details. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Treasuries receive a jolt after soft US jobs data supports the case for a supersized rate cut by the Fed. Stocks, though, treading water ahead of tomorrow's key reading on non-farm payrolls. Kamala Harris breaks with Joe Biden on tax rates. The US Democratic nominee says those earning $1 million or more should pay 28% on capital gains. Plus, Ukraine's President Volodymyr Zelenskyy is set to nominate Andriy Sybiha as foreign minister. That's as part of the biggest cabinet reshuffle since Russia's invasion in 2022. So on the data front, on the markets front, it has all been about the jobs data out of the US. And you saw softness yesterday in terms of the jolts or the job openings, the number of openings falling to the lowest level that we've seen since the start of 2021. That saw a move of money again into US Treasuries, the benchmark 10-year dropping in terms of the yield by 8 basis points. The setup then for the equity markets on this Thursday, soft, a lack of conviction, waiting for the next catalyst, and that is likely to come from the non-farm payrolls print. That jobs data, of course, dropping tomorrow. European futures pointing lower by 0.2%. FTSE 100 futures looking to lose 18 points. The softness, of course, yesterday across European stocks. S&P futures currently just down by 0.1%. NASDAQ futures looking to losses of 31 points. Worth noting that Nvidia has seen its biggest two-day drop since, around October of 2022. Let's flip the board and look cross-asset. We talked about that pronounced move once again into Treasuries. That's where the action was yesterday on the back of further evidence of a cooling US labour market. 376 right now at the front end on the 2-year, essentially flat with the 10-year, and that has been marked the disinversion that we've seen, at least temporary, around the 2s, 10s curve. Euro dollar at 110, Brent $72 a barrel, up 0.3%, reporting suggesting that maybe OPEC Plus will hold back on putting more oil and barrels on the market come October. Iron ore under pressure once again. Look at that drop, 2%, building on the losses of this week at $90 per tonne. So we'll look again at the basic resources sector as pressure and concerns out of demand for China continue to weigh on iron ore. Now to geopolitics, and Ukraine's president set to nominate Andriy Sybiha, as we mentioned, the former ambassador of the country to Turkey. That's as the country's new foreign minister. It is part of Kyiv's biggest cabinet reshuffle since Russia's invasion began in 2022. Our Russia economy and government editor Greg Sullivan joins me with the details. Greg, why is this reshuffle coming now? What does it signal?
Well, Ukrainian President Volodymyr Zelenskyy has said that he wants a new emphasis both in domestic and foreign policy. The move still caught Western allies, Ukraine's Western allies, off guard with its suddenness. But there's no doubt that there is a crucial time for Ukraine. Ukrainian cities have been facing huge barrages of missiles targeting energy infrastructure ahead of the oncoming winter. And they've also struggled to stop Russia's incursions in the east. So it is a critical time. And if he did want to take a new emphasis, this might be a strategic moment where he could make those changes.
And what's the assessment then, Greg, as to how this either strengthens or undermines Ukraine's ability to fight in the war? Do they want that consistency? Would it have been beneficial to have a consistent cabinet makeup? Or does it work to reshuffle and re-energize the cabinet, given the challenges Ukraine faces?
I can't underscore enough how crucial this role is for Ukraine. Ukraine relies a lot on Western support, both to run its government and to fight its war. Kuleba was a well-known face in the West. He knew many of the diplomats. But Sybiha is an accomplished diplomat in his own right, having been in Turkey and Poland. Poland, a key backer for Ukraine. But whoever they have in this role, it's important that that person be strong. And in some ways, this is an interesting move because he was in the president's office and worked directly with the very powerful chief of staff, Yermak. So it might actually strengthen internal cohesion. But there's no doubt that this is a very important role, and Zelenskyy must have confidence in him placing him into it.
OK, we have IMF stuff on the economy then. IMF stuff on the ground in Kyiv this week. What are they pushing for? What is the aim? What is the goal for those IMF members on the ground in Kyiv this week?
That's right. They're in the on the ground doing a review that could unlock almost $1 billion disbursement of funding. Some of the things that they're expected to push for are cuts in the interest rate, a devaluing of the currency, and a stronger tax base. That's politically tricky for Kyiv. They already have a citizenry facing blackouts, wartime mobilization, and other challenges, and then being called upon for a weaker currency, which the national bank is said to want to resist, and more taxes. That could be a fine line to walk. But again, I have to underscore, Ukraine's government does rely on Western funding, both to run its government, such as with these IMF funding, and for its military. So a tricky line to walk for Ukrainian officials on this one.
OK, Bloomberg's Russia economy and government editor Greg Sullivan with an important update in terms of the reshuffle and the demands, or at least the requests coming through from the IMF in order to release that funding. Thank you, Greg. Now to some other stories making the news this Thursday. A long-awaited inquiry report says the Grenfell Tower fire here in London was a result of a catalogue of failures by the government, local councils and construction industry. The report follows years of testimonies and hundreds of thousands of documents examining the disaster that killed 72 people in 2017. Bloomberg understands the UK is to make further changes to water company insolvency laws as fears grow that debt-laden Thames Water will run out of money next year. It's the first time the new government has hinted that special administration, a form of temporary nationalisation, is an increasing possibility for Thames. The company, which supplies water for 16 million people in and around London, is seen by the government as too big to fail. Nvidia shares fell for a third session in New York, now down around 14% since last week's earnings outlook disappointed investors. Meanwhile, the company says it is in contact with the US Justice Department, but has not been subpoenaed over an antitrust investigation. And AI chip demand will boost growth for the broader semiconductor industry over the coming years. That, at least, is the view of a major equipment supplier to TSMC in Taiwan. The CEO of Scientech spoke to us in an exclusive interview.
We are lucky in this AI industry. We benefit from the equipment that we build, the process that we develop with customers together to enable AI process. So that's why our investors value Scientech as a potential company who can really contribute in this industry.
And what sort of demand are you seeing? What's your outlook for demand for your equipment toward the end of this year, but next year as well?
The growth will be substantial for next few years. The increase, the growth rate, which will be much, much higher than 8%.
Can you give the number?
The equipment that we sold to them probably increase 2 or 3 times a year. It is possible. And so it is also benefit Scientech from their revenue.
Do you see any risk to that outlook?
From my personal perspective, this booming of AI industry just begin. There's a lot of application I do expect will coming out pretty soon. So that's why Jensen Huang, some time ago, he said the overall market of AI will reach 100 trillion at some point in the next probably few years.
We're seeing a lot of Taiwanese companies that are choosing to expand abroad. Do you see any sort of concentration risk from choosing to focus your attentions here?
Of course, definitely we will try to evaluate alternative locations, either for the R&D, for the manufacturing. Internally, this is under our processing.
Speaking more broadly now, what has been really capturing a lot of attention in the chip equipment manufacturer space or chip equipment provider space is the measures that we're seeing applied on Tokyo Electron and ASML and restricting sales of certain equipment to mainland China. That risk of tariffs or being prevented from selling to the Chinese market. Is that something that concerns you or Scientech as a business?
My direct answer to you is no, because the equipment that we built are mainly for packaging applications, and the packaging applications is not included in this limitation.
Do you see that risk ever appearing in the future? Is it something that you're looking at closely?
We all know the advanced packaging is becoming more critical every day. Most likely it will happen, but who knows?
Scientech CEO speaking exclusively to us in Taipei around demand for AI equipment in the chip space. Now, President Biden is said to be preparing to block Nippon Steel's $14 billion takeover of US Steel. Sources say a decision could come as soon as this week. For more, let's bring in Bloomberg Commodities reporter Martin Ritchie. Martin, what do we know? What's the latest? What's next in this saga?
It looks like this $14 billion bid by Nippon Steel, one of Japan's largest steelmakers, for the iconic US steel firm, is hitting the blocks. As you said, Biden, according to people familiar, is going to reject the proposal after his Committee for Foreign Investment reviews. Puts paperwork on his desk, perhaps as early as later this week. Now, for Nippon Steel, it's a big blow. They were hoping to, expand their footprint globally as domestic demand for steel ebbs in Japan. And for US Steel, the company itself had agreed to this takeover. Their shares slumped. We're down 17% by close of business yesterday. And the boss there has warned that without that takeover by Nippon Steel and all the investment that the Japanese company were promising, without that, they'll actually have to close down. So, it's kind of bad timing in a way. Politics has, in the US in an election year, has done away with this deal, it looks like.
Yeah, the political timing clearly a headwind for Nippon Steel in this bid. What does it mean then for Nippon Steel, the business going forward?
Look, there's the immediate response to this, both on a political level and on the company level. Nippon Steel, US Steel has said they will pursue legal options if the deal is blocked. Nippon Steel has said, they will. They hope that the US can treat this in a lawful way, which is, I guess, is a hint. But I think from the people we've spoken to already, it doesn't look like there's going to be much route ahead if the deal is turned down on national security grounds. Nippon Steel doesn't have that many other options. It's trying to expand to retain its clout as the Chinese steel industry expands and becomes more sophisticated. That was a transformative transaction, and if it doesn't happen, it doesn't have that many other options.
And Martin, look, you touched on the politics, and we've got a couple of lines from one of the Japanese cabinet ministers, or at least government ministers, 30 minutes or so ago, saying that they believe, this is from Tara Kono, we believe the US government stance on US Steel is due to winning votes. Kind of pretty interesting comments coming through from a senior member of the government in Tokyo around this. What do you expect the diplomatic fallout to be?
I suspect pretty limited. Of course, from the Japanese side, they will want to, register, I guess, displeasure or whatever. You've heard he's one of the prime ministerial candidates, I believe, or potential candidate when Kishida departs at some point. But really, this is relatively small fry compared to the broader strategic priorities for the US when it comes to the Japan relationship, and perhaps and that makes Japan's options fairly limited in terms of what it can do in response. Kishida is due to go to the US for the UN General Assembly later this year, and I think strategic competition with China and that strategic alliance between Washington and Tokyo is perhaps much more important than a takeover of a steelmaker. So I think Japan's options may be fairly limited.
Okay, really important context. Bloomberg Commodities reporter Martin Ritchie with the latest on that story reports that the US will be looking to block that takeover, Nippon Steel, of US Steel later this week. Coming up, tumbling sales and profits, and now it's been relegated from the FTSE 100. The stock, by the way, down around 50% year to date. Yes, we're talking Burberry. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, UK luxury brand Burberry is to drop out of the FTSE 100 later this month, with insurer Hiscox taking its place. Burberry is being relegated after its market cap fell by a third over just the past 3 months as consumers continue to tighten their wallets. For the details, let's bring in Angelina Rascowit, our European luxury retail reporter. Angelina, what's been? It's indignity after indignity for Burberry. What's this relegation's going to happen later this month? What's been happening to this company? What are the major headwinds for Burberry at this point?
Hi there, Tom. Indeed, it's been very tricky. I mean, basically, Burberry and the whole industry has been facing a downturn in demand compared to the post-pandemic boom years. So 2023, we saw the slowdown and it accelerated in 2024. And the issue with Burberry is that it's in turnaround mode. So basically, they had a CEO who lasted for about 2 years. He was let go in July and they named a new CEO, Joshua Schulman. And he's going to have to basically chart a new path for Burberry. We don't know exactly what he's going to do, but he'll present his plan, his big plan in November. But basically, I mean, the elevation strategy, basically to become more premium in the eyes of the consumer, more exclusive, that hasn't really worked so far.
So lay out for us what the key challenges are then for this new CEO.
Indeed. So the new CEO, he comes from Michael Kors, which is considered to be affordable luxury. So the question that investors ask themselves is that will Burberry try to become a Michael Kors? You know, will it become more affordable luxury instead of trying to become more exclusive by offering leather bags and shoes? Basically people were saying that it was trying to become more like Hermes or Louis Vuitton. So that's the question mark. The other question is that how will he get along with Daniel Lee, who's the creative director? He was named under the previous CEO, and typically when a fashion CEO is named, he or she likes to name their own designer who will translate their preferred commercial vision. So we'll have to see about that. We know that the teams internally at Burberry have been facing pressure because under collapsing sales, you want to put out winning designs, but when you're seeing the quarterly sales go down, that's not very encouraging. So there's a lot of pressure there. And so that's pretty much what he's going to be focusing on. So we'll hear from him in November for the 6-month earnings of Burberry.
And Angelina, what you've done very effectively is outline some of the idiosyncratic story around Burberry, but you also touched on the point that this is a sector, luxury, that is struggling. We've got a reminder of that today with Tiffany looking to reduce the size and scope of its flagship store in Shanghai in China. China is a factor and it's weighing on a number of these luxury brands. What is happening across the luxury space more broadly?
Indeed, Tom. Basically, China, the consumer appetite in China is not there. There are worries about the economy there, youth unemployment, the property sector. And China, over the past 30 years, became really like the driver of this sector. But what we're seeing as well is that the U.S. demand is quite soft. So in different geographical locations, you're not seeing the growth that you'd want to see. And if you're a brand just like Burberry, but if you think about also Kering, the biggest brand that Kering is Gucci, if you're in turnaround mode, that makes it even harder to pull through.
Angelina Rascowit, our European luxury retail reporter, with a fantastic take there on what is happening for Burberry and the broader luxury space, a story we continue to monitor. Burberry stock down 50% year to date. There's plenty more coming up. Stay with us. This is Bloomberg.
when it comes to the consumer, what we continue to see is a somewhat steady consumer.
Over the last year, things have settled out, but they haven't in any way pulled back in a meaningful manner.
Asia is the fastest growing market, including China, Japan, Australia.
China's a fantastic market.
Not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful.
In terms of a major pullback, no, we haven't really seen that yet.
Analysts and executives at the Goldman Sachs Retail Conference in New York opining on the state of the US consumer, which of course ties into your views about US equities. Still near those record highs in the debate as to whether or not that can continue, given the challenges around the labour market. We'll unpack some of that data just in the next minute or so. But here's the difference when it comes to the US equity performance and valuations versus their Chinese counterparts. Chinese equities now trading below 50% in terms of valuations versus their Chinese US counterparts. The CSI 300, the benchmark in China, is down 14% year to date. You are set potentially for a fourth, and this is unprecedented, fourth consecutive year of declines for Chinese stocks. Look, the difference is partly in valuation, partly down to what's happening with the Mag 7 in the US, but also partly, of course, down to the risk aversion around getting exposed to Chinese stocks. Let's get back to the data story out of the US, though. Flip the board, have a look at jolts before we get on to the preview around ADP. So the jolts numbers, vacancies down and missing all the estimates in the Bloomberg estimates, and layoffs up. The ratio, by the way, of vacancies to the unemployed also coming in lower than the expectations at 1.1. We know the Fed scrutinises that number. So the softness in the jolts number saw that money moving into treasuries once again yesterday. Concerns about the cooling labour market. You look ahead into ADPs then, we'll flip the board and have a look at that, because ADPs are actually expected for the month of August to tick up to around 144,000 from 122,000. That print that came through for July, the weakest since the start of the year. You're expected to see a slight tick up in terms of the ADP numbers that cross later today in terms of those private payrolls in the US. But we'll look for the wage growth. Will you get wage growth still above 7%? That will be consequential as well in terms of how the Fed is thinking about its next move and how the market interprets the aggressiveness of the next cut from the Federal Reserve. Coming up on the opening trade at 7:30 a.m. UK time. Do not miss our conversation with John Neal, the CEO of insurance market Lloyd's of London. That conversation coming up on the opening trade. That is next. This is Bloomberg.